Hello and welcome to this market update for January 2023. I am Michael Ball with Weatherstone Capital Management. As we kick things off for 2023, the primary areas that we wanted to cover were to look at the performance that we experienced across financial markets in 2022 and give some historical context to put that into perspective. We want to take a look at some of the important recession and inflation indicators, as it appears that we're moving from where the primary driver of financial markets is fears of increasing inflation, and it's now moving to fears of recession, and will it be a deep or a moderate or maybe even fully avoid a recession. We'll take a look at some of the recession indicators that are worth watching to give a more real-time update as to what's happening, and then we'll discuss our positioning in both equity and fixed income portfolios. 2022 was one of the toughest years for investors in quite some time. If we look across some of the major asset classes, we saw stocks down nearly 20%, which was a very deep year, but still off of its worst levels on the year. Bonds did have their worst year in decades, being down more than 13%. On a global basis, stocks did not fare much better. The world stock market index was down about 17.5%. Gold, which will normally do well in times of inflation, did not have a very strong year. It did eke out a gain, but less than 0.5%. And then Bitcoin, which some people were touting as being something that would behave differently from other investment classes, fared the worst of all in this environment, dropping roughly 65%. To put the stock market decline in a little bit more historical context, I thought this chart would be helpful, which goes back roughly 45 years. And this shows in the gray bars what the annual return was for the stock market, with the red dots being what was the maximum decline during the course of the year. So looking back over this time frame, 2022 ended up being the third worst year during that time frame, only surpassed by 2022, and then during the global financial crisis, the decline that we saw in 2008. And also interesting relative to some of the other prior years is where we ended the year was also really quite close to what the maximum decline was, which doesn't happen all that often, but it does speak to the persistent nature of the overhang that we had from inflation and the concerns that would cause, just kind of pressing down on the stock market and its performance throughout the course of the year. In looking at the declines by asset classes in a historical context, the major asset class that really fared the worst was bonds, which, if we go back even further, we're looking at nearly 50 years worth of data for the Bloomberg Aggregate Bond Index. We see that the 13% decline that we experienced last year was by almost a magnitude of more than 4 worse than any year that the bond index has had. And the maximum decline was also nearly twice what we had seen in even the worst of years, at nearly 17%. So it was pretty unusual, particularly since we'd also had a negative year in 2021. It was the first year in which we've had back-to-back negative years for bonds. And so while that has been a tough 18 months or so for bond investors, there is some signs of hope in that area that can be quite encouraging, and we'll talk about that further later in the commentary. In looking at how a mixture of stocks and bonds performed last year, we come up with, once again, the third worst year. This time, if we take things going back all the way to 1950, our minus 16% that we experienced was only eclipsed by the global financial crisis, and then during the mid-70s when you had the very significant recession and the Arab oil embargoes and things of the 1973-74 era. So that was certainly a tough year. The good news out of that is over our investing lifetimes, years like this don't happen very often. So the likelihood that we end up with another one anytime in the near future is at this point a lower probability event. As we look at inflation, which really drove a lot of the concerns across financial markets, this chart can be helpful in terms of looking at the levels that we experience, the risks that we continue to have in this area. So the top clip of this chart shows the inflation rate on an annualized basis going back to the early 1960s. And you can see that the spike that we had into last year reached the highest levels that we had seen since the 1970s into early 1980s, when interest rates actually got up into double digits in an effort to quell the more persistent inflation. The bottom clip is an inflation model that we use from one of our research providers that looks at how much inflationary or deflationary pressure is out there in the system. And so you can see there in the orange lines that once the government stimulus money really started to flow through the system, that inflation pressures ratcheted up quite strongly as we got into 2021 on the latter half, and then throughout most of 2022. But over the past few months, we've seen that move from an area where there was strong inflationary pressure down to weak, and actually at this point some deflationary pressure as supply chain and other issues start to get worked out more, and we're now starting to see potentially some prices starting to reverse themselves somewhat. So the likelihood that we see inflation be as big of a concern and continuing to march higher in 2023 is significantly reduced from what it was over the past 12 to 18 months. A very good way to look at what's happening in terms of interest rate levels and pressures is to look at the trends in the 2-year Treasury bond market. This is something that tends to precede what the Federal Reserve does with short-term interest rates. 2-year Treasury bonds are more driven by market expectations than what the Federal Reserve is actually setting for interest rate policy. We saw here interest rates moving up quicker on this as we moved into 2022, and we have now started to see the yields top out around 4.75% and start to move lower back down closer to about a 4.25 or closer even a bit to 4% here most recently. With that, the Federal Reserve still says that they're planning to hike interest rates, but I think we're starting to see enough slowing in inflation and some of the economic weakness that the Federal Reserve may begin to reverse some of their interest rate hikes quicker than what they are currently talking about, which would further relieve some of the potential economic stresses that we have out there. As we look to the factor that I think will have the biggest impact on financial market performance in 2023, it's going to be economic activity. Are we going to have a recession? If so, how deep might it be? How long might it last? Can we avoid a recession? Going back to one of the models that we follow from one of our research providers, they've built one that looks back over decades and kind of is designed to look at more real time. What is the strength and weakness and recession probabilities in the economy? Part of the reason this is helpful is that the group that does date and determine when recessions start and end wait for revisions to the data, and they typically give us that information 9 to 12 months after recessions have actually started and ended. So when we're looking at things in real time, information that tends to coincide with either leading or concurrent with economic contractions and expansions can be quite important. So looking at the economic model that they have, it's had been in quite a strong growth mode up until about the middle of 2022, and then started to weaken. It's now weakened up into the area where it's typically indicated a mild recession, and it's deteriorating further down to where it's closer to a moderate recession. It appears that most financial assets have priced in a slowing economy and at least a modest recession. Most of the financial markets have not yet priced in a potentially deeper recession. And so this will be key, because the declines that we've seen are consistent with a mild recession. If we have a deeper recession, typically stock market declines are closer into the mid 30s to upper 30% range. So that could bring stocks down by about another 20 plus percentage points from where they currently are at. So if we're able to avoid that, stocks could have a pretty solid 2023. If we continue to see economic weakness, things could get bumpy and we could still have lower lows ahead of us. In terms of some of the economic type indicators that we're looking at, this clip in the chart in the bottom right hand corner regarding consumer finances is going to be very interesting to watch over the coming months. This is basically looking at the household excess savings levels. How much are people saving or spending on a monthly basis? And the light blue line kind of looks at the excess savings, because as everything slowed down during COVID, people ended up saving a lot more, plus there was government stimulus that a lot of people received, and so savings balances built up quite high. But as inflation picked up, consumers began to spend that money out of savings or borrowed on their credit cards in order to better pay for some of the expenses that were coming up. And so that's actually been running negative over the most of 2022. If we see that continue and consumers continue to deplete out their savings, then they're going to begin to be forced to curtail spending, which will have a larger overall impact on the economy and could push us deeper to recession. If we see this start to stabilize and come back more into balance, with consumers living within their means and not spending out of savings or debt to maintain their lifestyle, then we're in a better position to be able to navigate through this environment. Another key measure to watch is the purchasing managers indexes, which can be reported by most countries around the world. This chart here basically takes those numbers and color codes them. The stronger the numbers are, the darker they are green. The weaker they are, red. So green is good, red is bad. If we look back historically, this takes us back through the back half of the global financial crisis, which we can see a lot of the red there on the left-hand side, and then the COVID decline in 2020. Currently, you can see that over the past year or so, this has moved from being predominantly green to being more yellowish, a little bit of orange, nothing too severely on the red side. But if we do see more of this picking up onto red and some of the more current readings are a bit weaker, then that's going to be an indication that the global economy has started to reverse more on a worldwide basis. One of the more hopeful areas for the economy has been the strength in the jobs market. And we've talked about this chart in the past, but it continues to bear watching. Some of the things that are helpful on this chart is on the left-hand side, it shows the ratio of job openings to job seekers, still on a very strong level relative to historical cycles. That's even with some of the increases in corporate layoffs that we've been seeing from some of the technology and a few other firms. Also on the bottom right-hand side, when we look at the number of layoffs, we're still at well below average levels, even though we've been experiencing some uptick. So a strong labor market tends to be very beneficial for consumer spending over time and consumer confidence. So if this can remain strong, this is one of the most helpful or hopeful signs for the economy at this point. So when we take a look at how the declines have impacted the valuations across stocks and bonds, this is looking at the forward-looking price to earnings ratio for stocks. We can see the history here going back a little over 25 years. We're back right at about the average during that time frame. We've come back from where we had been on the top end of that spectrum. So a bit more negative news has been priced in, bringing us back down. It's obvious we haven't priced in some of the more difficult scenarios like we had during the global financial crisis or when we had the European debt crisis there in 2011. But we are at a more constructive level overall for stocks. And so if conditions can stabilize and improve from here, this is probably a pretty good time to be accumulating and adding more to stocks. But as we can tell from levels that we've reached during more difficult environments, if we were to deteriorate from here, there is quite a bit further that valuations could fall. The picture is a bit different when we look at bonds. This chart shows on the bottom line where interest rates were across different maturities at the end of 2021 and where they are at the end of 2022. The gray area is showing the range over the past 10 years. If we look at where we're standing now, we're very near the highest yield levels that we've seen over that time. This gives us a lot better opportunities than when yields were very, very low, and both from a standpoint of economically sensitive bonds, if the economy were to improve from here, there's some pretty good upside potential. If we look at even government bonds, and if we do go into a deeper recession, then the government's likely to be cutting interest rates, and that could drive up the prices of those bonds as newer bonds issued by the government are going to have lower yields. So we see a better opportunity set across fixed income than we have seen in quite some time. Going back to a slide that we've touched on in the past, when we look at what the pricing has been in recent months over high yield corporate bonds, which are more economically sensitive, these are priced down in that 80 to 90 cents on the dollar range, which is the second grouping there on the left-hand side. And historically, when the starting prices, when you're buying bonds in those ranges, you've been able to make well above average returns historically over the next 1 to 3 years. Whether that were to materialize this time will once again be highly dependent upon any potential severity of a recession. But the key point here is that the pricing and the historical profile shows that there are starting to become more and more compelling opportunities in fixed income asset classes. And so with that as a backdrop, as we look at current positioning in fixed income portfolios, we've moved from where 3 or 4 months ago we had the bulk of the investment portfolio in ultra short-term bonds that were not as impacted as interest rates moved higher, to now having a much higher weighting in high yield corporate bonds, in municipal bonds, and in bank loans in the investment portfolio. This is due predominantly to some improving risk measurement models for stocks and other economically sensitive assets. Whether this may be a shorter term trade or something longer term is really pretty hard to determine at this point, but at least there's a window of opportunity in these asset classes to make some attractive returns, we feel. As noted, high yield bonds are currently priced at levels that have historically in the past provided us with some nice returns. In the past couple of years, we have also heavily used housing bonds in the portfolio. We largely moved away from those over the past year as housing started to look weaker, and we wanted to move away from some of the risks there. And in hindsight, that turned out to be a prudent decision. We're starting to slowly rebuild a position in housing and mortgage bonds at this point. And if the housing market begins to stabilize further, that may be another area that we move to an overweight position, and it's worked very well for us in the past. One area that we're not utilizing heavily at this point, but which we may do, are foreign bonds. This is an area that we don't use real frequently, but given the situation that we ran into in 2022 of also having a very strong US dollar, that makes the appeal, as interest rates may begin to move lower, of owning government bonds or corporate bonds that are outside the US and then experiencing a decline in the US dollar as it moves back into more normal levels relative to our currencies, more attractive, because we may pick up attractive interest rates and then also get, let's say, an extra 3, 4, 5% return from the fluctuation of the dollar from kind of its above average levels versus other currencies back to more in line with historical norms. If we look at how we're positioning our tactical investment portfolios across stocks and other assets, we've been increasing stock exposure over the past few weeks as our shorter term risk measurement models have begun to turn more positive. As noted previously, this may just be a shorter term adjustment, but we are seeing enough positive movement there that it warrants allocating more to stocks. Reinforcing that, and somewhat interestingly, given the weakening economic environment, is that we've seen our measurement model for commodities also turn positive. We wouldn't normally expect this to turn positive if we're seeing increasing recession risks, but this has also turned positive for the first time in more than 6 months, so we've added some exposure there. In addition, we've added international stock exposure. It's a little bit larger than what we've historically added in the past. That's because of the fact that the valuation levels continue to be quite attractive, and as people are moving away from technology stocks into other areas, that does tend to push a little bit more money to some of the foreign companies. And then, as mentioned, with the high value on the dollar, as that starts to come down, that can provide a little bit of a tailwind for our investments in those areas. In terms of sectors that we're overweighting a bit in the portfolios, that tends to lean currently towards the consumer staple stocks and the energy stocks. In summary, it's great to have 2022 be behind us and to be able to move into an environment where inflation is going to be likely to be less of a factor driving markets. Even though there is the risk of having a recession out there, that also started to get priced into many assets in 2022. What didn't get priced in is the likelihood of a severe recession. So that's the primary risk that we need to watch out for. We see a number of areas in the bond market that are really quite attractive relative to what we've seen in the past, and we think there's a good likelihood that the year's going to be able to provide above average returns for bonds. Our risk measurement models for stocks and commodities are turning positive. Given the declines that we've seen and more attractive valuations, this does have the potential to also be a very good year for those asset classes, but it will depend largely on the recession risk. Also, we think internationally this could start to be a trend of multi-year outperformance by those segments of the market, and so we have above average allocations to those areas. With that, thank you for taking the time to listen to this commentary. Reach out to us if you have any questions, and we look forward to talking to you again soon. Thank you.